Okay. So where were we? Do we have any other comments except those ones? We have a kiki. Okay. Emily. Okay. Okay. So these are the conditions we say where we are transferring a move a business property from your private use to now business use. We say there are no capital gains consequences, but there are conditions that must be met before you assume you make that assumption. The first condition is that the property must be used for the purpose of trade, of your trade. Then number two, taxpayer is deemed to have control if he has more than 50% shareholding. Then number three, no liability arises on transfer. Then number four, CGT will only arise when the asset is resold by the taxpayer company to a third party. That is just clear. Oh, I'm still running. Ah, okay. Uh, we have the issue of roll forward. That's when we have reliefs there. So pay attention. Capital gain roll forward simply refers to a deferment or postponement of tax liability on that part of capital gain which is attributable to amount spent on a new replacement of a specified asset. Okay. So sometimes we say, okay, I'm selling my PPR, the principal private. We should also be able to define what is a PPR. It's just there in the act, I think in section 2. Okay, sure. Let's say I'm selling my principal private residence for 500,000. That was in Blawaya. I want to relocate to Harare. Then in Harare, I'll buy another PPR for 400,000. That means I haven't spent 100,000, isn't it? The Blawa PPR was sold for 500, but the Harare one, I'm buying it for 400. So there is that 100,000 that is not spent. Okay, sure. Now, the row forward is saying capital gain row forward simply refers to a deferment or postponement of tax liability on that part of the asset which is attributable to amount spent on a new replacement asset. So, when you are now calculating your capital gains, your gross capital amount will be the 500 that you got, isn't? Okay. Then you do your deductions. But now, when you have now calculated your capital gain, okay, you don't just apply the tax rate there because you remember that out of the 500 that was received, only 100,000 was not spent. The 500, the 400 was spent. So capital gain that is related to the 400 will be deferred. So what would you do there? You would say 400, which is the amount spent, divided by 500, which was the total gross capital amount. Then you multiply by the capital gain. That will be the relief or the roll forward or the deferment or the postponement. Okay, roll forward relief on sale of PPR. Uh, that is what I was explaining. So what is this? This is an option to postpone the payment of CGT. No capital gains arises where the full proceeds are used to acquire or to construct another PPR in Zimbabwe on land owned by the taxpayer in the tax year of disposal or in the tax year after the year of disposal. This is called the full roll forward. So, like the example that I was giving, if the RR PPR was now acquired for 500 exactly, then of course there won't be any. The whole capital gain will be postponed. Okay. That other time we were just postponing the capital gain that was related to 400. That was the amount spent on the new PPR. But in this case, uh, uh, if we spend the whole 500,000 on a new PPR, that means there won't be the whole capital gain related to that asset will be deferred. Okay. Where only a part of the process are used to purchase or construct a new PPR, the capital gain on sale of the old PPR is apportioned in partial tax. That is, there is partial C capital gains relief on the expended portion of the process, and C capital gains tax arises on the unexpended portion of the process. I think that is what I was saying. Okay, so how do we calculate it? The partial roll forward. We say A over B multiplied by C, where A is the amount used to purchase or construct the new PPR, that was the 400 in our case. Then divided by B, B is the process from the sale of the old PPR, that was the 500,000 in our case. Then C is the potential CGT on the old, C capital gains on the old PPR. So you would have calculated your capital gains using this. That is why we had this format. So what is happening here? You calculate your capital gains as usual. So this will be the result after applying your deductions, your equipment, and so this will be the capital gain. Okay. Then we now want to apply a roll forward relief. So in our case, we will say 400 divided by 500. Then we say multiply by this. So the amount that we get will be the relief here. Okay, then you will say this one minus this one to get the capital gain or loss. Okay, so if we had assessed losses from previous periods or from previous assets, we also deduct them because we know that an assessed loss is an allowable deduction. That is what we mean there. The Commissioner General that the capital gains that is being rolled forward, whether full or partially, effectively reduces the cost of the new PPR when calculating CGT in the future. Okay, so we are saying we have postponed the payment of CGT, but what will be the effect in the future? Because if we postpone something, it will happen, but just we have just deferred it to some other period. So the question is, what will be the effect in the coming period? Maybe uh, when we subsequently sell the asset. So the excess, the capital gain, uh, that would have been rolled forward on the sale of the old PPR, whether it was rolled forward in full or partially, will effectively reduces the cost of the new PPR when calculating CGT in the future. So what we are going to do, we are going to say, okay, the cost of the new PPR is 400,000, isn't it? Then you have to deduct the CGT, the capital gain that would have been rolled forward to calculate the new costs. However, inflation allowance on the UPR is calculated on the original cost before reducing the cost with the roll forward. The inflation allowance, we allow it on the 400, not on the reduced amount, but the cost will be reduced. When land, storeroom, or any other structure which was used together with the PPR is sold separately, roll forward provision do not apply because this is not a disposal of a PPR. So you see, this roll forward is applying to the sale of principal private residence. Where the taxpayer is to top up the sale proceeds of the old PPR in order to acquire the new PPR, then there is no there is a full roll forward. Number B, the extra amount spent by the taxpayer is considered an improvement when the new PPR is eventually sold. Hey, tax is nice. It's low. Said I don't know or you know. But I wish that you know. Okay, land in a rural area does not have title deeds and thus cannot be owned by the taxpayer. Such land is state land. Hey, okay. Uh, Notably, capital gain rollover simply refers to deferment or postponement of tax liability on that part of the capital gain which is attributed to an amount spent on the new PR. Remember, the purchase price includes stamp duty, transfer fees, bond raising fees, etc. It will be incorrect to consider only the purchase price as shown in the agreement of sale. For rollover to apply, so these are the conditions. The taxpayer must satisfy the Commissioner General that before end of the tax year following that of sale, he will purchase or construct uh, another PVR or on land owned by him. So uh, if you sell your PVR today, is 2021, isn't it? You have to make sure that by end of next year, you should have about another PR or construct another one for the of over or forward to apply. In that, PR should have been constructed in Zimbabwe. So if you go and construct the asset in South Africa or any other country that is not Zimbabwe, then the rough one will not apply. Now we want to cover this example, but before we cover the example, let me see if we can save our recording. It's now no, it's still 11 minutes, so let's just finish the example. Okay, so it's saying if Paida, there was an example on those other slides, used 28 of proceeds from the Unit B house to purchase a stand in Westgate on which she intends to build her new residence. Calculate the applicable CGT if she uses the provisions of Section 21. Okay, so it's very important that we go to the example number one. Now we are on slide 56. Okay, so example one, this was the example. Yet this let me just put the 2021 ones. Then here, because we are now using a bond note, we put them in millions. So Peda sold the house in UK for 3.5 million. The cost of selling the house was 4 million. The house was bought in March for 5,600 million. She added extension cost of 3,200,000 in July 21, 20. Calculate PIDAS tax liability. Okay, so this was the answer. Do you think this answer is correct? And I don't think it's correct. Why do we say this answer is not correct? I want to see if you're listening or we are just playing here. Why is this answer not correct?
I think it's because of the location of the property.
Exactly. We initially said he should be from a source within Zimbabwe, isn't it? But this one is in UK, a UK house. So there are no CGT consequences there. I don't know why this slide was there. So is there. So let's change the location to Blawayo here so that we don't confuse ourselves. So what happened here? The gross capital amount is 3.5. The cost of selling the house was 400. The cost of buying the house, let's just say in 2016, was for 560. She added an extension of 320 in July 2020. Calculate the CGT liability. Okay. So what we do is we say gross capital amount. Is it 200,000? Then we say less recoupment. Then less exemptions. Okay, so let's do working number one on the recoupment. Okay, so we refer the recoupment to working one. Okay, so we have two issues here. We have recoupment on the cost, then recoupment on the improvements. So let's just say put improvements here. How much was the cost? The cost was 560. Okay. What about the improvements? The improvements were 320. Okay. So we are not told whether this PIDA was minimizing tax liability. So we assume that on this, okay, this one is a private house, so there are no issues of recoupment there. So let's not assume because it will confuse our example too. Okay, so let's forget about recoupment because we know that we can't claim capital allowances on a private house or private asset. Okay, we only claim capital allowances on those assets that are being used in business. So on exemptions, let's check if we have any exemptions that are applicable here. Either we are not told whether she is elderly or not, so it will not work. The exemption will not work here. Okay. So after that, so we have our capital amount. Okay. So actually call it capital amount. Okay. Then we say less deductions. What deductions do we have here? We have the costs. This one is given, isn't 560? We have inflation allowance on the costs. At what percent? At 2.5%. Okay. So, what do we say? 560 multiplied by 2.5% multiplied by how many years now? This asset was acquired in 2016, so we count 2016, 2017, 2018, 2019, 2020, 2021. We also count it, so it's 6 years. Okay, so we also have improvements. We are given that the improvements are 320, so put them in full. They are deductible, 320,000. Then we also have inflation on the improvement, also at 2.5%. Okay, so again, we say this multiplied by 2.5% multiplied by how many years? The improvements were done in 2020, so we have 2 years only, 2020 and 2021. Okay, what else do we have? We have selling expenses. We are given that the selling expenses are 400. Okay, so we calculate the capital gain. Capital gain will be this one minus this one. Okay, so this one will be the capital gain. What was the question saying? The question was saying calculate the capital gains tax liability. Okay, so this asset was acquired in 2016. Now it's being sold in 2021. So CGT at 20%, CGT, CGT at 20%, then we say the capital gain multiplied by 20%. That will be our capital gain tax. But this solution is not right. The 364 100,000, they say up to CGT level there, row number 11 is correct. But to say CGT at 20% is not correct. Can anyone tell me why it's not correct? I want to see if you are listening or you are just. I don't know if you are copying because the person I'm traveling, you won't be able to copy. Anyone? Okay, maybe if you see this slide, you remember. Okay, so this is the issue of CGT rates. So this slide summarizes all. So the slide says if the asset, if you look that red on the key, the red color will represent the acquisition date. The green color will represent the disposal date. Okay, so we are saying if the asset was acquired before dollarization, dollarization happened on 1 February 2009. So if the asset was acquired before that date and sold any other date after that date, we don't have capital gains consequences there. We only have what we call capital gains withholding tax, and the rate is 5%. 5% on what? On the gross capital amount. Second, if the asset was then acquired after dollarization, but before de-dollarization, de-dollarization happened on 20 February 2019. Okay, so if the asset was acquired in between these days and sold in between again those days, the capital gain will be 20%. The CGT will be 20% of the capital gain. If the asset was acquired in between this date but sold after de-dollarization date, capital gain will be 5% of the gross capital amount. And this is exactly the case we have. This asset was acquired in 2016 and then it is being sold in 2021. So it crossed. Who is now joining this time? Okay. So this asset crossed the red line. It crossed the de-dollarization date. It was acquired in between these 2 days. That means this period, the 2016, and then it is being sold after. So in this case, we don't do this computation. The answer should just be equal to, you just say the answer is the capital gains without tax at 5%. So it will be just 200 as the gross capital amount is multiplied by 5%. So that should be your capital gains without tax. It's not capital gains tax. The asset is not subject to capital gains without tax if it was acquired before, in between dollarization and de-dollarization, and then sold after de-dollarization. Okay. I hope that was clear, but I'm not happy that nobody picked this one. This is so confusing. You can waste your time doing this when you were supposed just to say 5% of the gross capital amount, then you are done. So the answer here should just be If we want to do correct things, the answer should just be capital, no capital gains tax chargeable, capital gains withholding tax at 5%, which is equal to 160,000. 5% of the gross capital amount. That was supposed to be the answer there. But for the sake of example number 2, so this is the correct answer on example number 1. This is the correct answer. So let's go back to our example number 2. What page was it?
656.
Okay. Good. Okay. So now he's saying, assume that if Paida, in example 1, used 28,000 of the proceeds from the Unity B house to, let's say, from Blawayo, because we changed Blawayo to purchase a tent in Westgate, that is Harare, on which she intends to build a new residence. Calculate the applicable CGT if she uses the provisions of Section 21 of the Capital Gains Tax Act. So that is the raw forward. So here, let's say she used 3 million, 2.8 million here. Okay. So let's assume that the debts were not crossing the red lines. This asset was acquired, is either it was acquired in between these periods, the asset was acquired in between here, it was acquired in between here and also sold in between here. So we do our normal computation, or it was acquired after dedollation and also sold after dedollation. So that is what we are assuming here, so that our example works. So if that is the case, we are saying after calculating capital gain here, we are now saying raw forward, or let's call it raw over relief. Okay. So the raw over relief will say, okay, the amount spent, which is the 2.8 million, divided by the total amount received, 3.2. Everything should be multiplied by 1.82, which is the capital gain. So that will be the relief. So we are saying 2.5 divided by 3.4, then multiplied by this. So that means we are rolling over 1.3 out of 1.8. Okay. So the capital gain after the relief will just be equal to this one. So this will be the capital gain after relief. Okay. So this is supposed to be the answer here. Okay, so we changed everything here, so the solution might not, this solution might not make sense. So we say, assuming the asset was bought and sold after 22 February 19. So we put this one. Okay. I just hope that was clear. Okay. So we have also what we call a reinvestment relief. It works exactly the same as the roll forward relief. So what is it? So this is in terms of section 22, where a taxpayer sells business property in order to buy or construct another business property. Any capital gain on the disposal is deferred to the extent that the proceeds are used to purchase or construct the new business property. The new asset must be constructed or purchased by the end of the tax year following that of sale or land owned by the taxpayer in Zimbabwe. Where the proceeds of the old asset are not fully reinvested on the new asset, Commissioner General is recognized, the capital gains is recognized uh, in relation to or in terms of the unexpended proceeds. So this is just exactly the same as we adjust the roll forward, the rollover, but we know that the term rollover we applies to a PPR. But when we now we're talking about business property, then we call it a reinvestment relief, and the calculations are just the same. So how you calculate the partial reinvestment relief? You say A over B multiplied by C, where A amount used to purchase, construct a new business property, B proceeds from the self-got business property, then potential C, C is the potential capital gain on the old business property. We forgot to save our thing. Hope it will work.